Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 287, 26th of September, and what a bad day it was for the longs in the market. The markets collapsed post the hawkish news from overseas from the weekend. The UK British pound collapsing early in the morning, and a dramatic sort of currency mayhem has been witnessed in the last few sessions. So today's topic is 0% return in 22 years. No, we are not talking about Japan, but we'll talk about the UK markets and see how the UK markets have performed and what diversified or asset allocated investors would have done. It is quite a market in flux right now. So there is no way to say whether this fall today is the end of the fall or we are anywhere near a leg up. It will now depend upon the dollar index finding some intermediate top at least, and that relief rally may start anytime soon because that is extremely overbought at 114 levels. And that along with the local interest rate hike that is coming this week, a lot of people are talking about 50 basis points plus. That also remains a largely a sign of worry for us. And emerging markets overall, South Korea and several other currencies are also taking a huge hit. So for emerging markets and especially in Asia, the 1996-98 contagion on currencies is being recalled and remembered, and the UK pound especially has taken a huge hit, coming to a 40-year low against the dollar. So here's the market. IT stocks barely up. The positive for IT is that the Indian rupee is also collapsing. It was at 81.6 or somewhere near that at the end of the day. So very quick 2 rupee fall in INR versus the dollar. That's almost 2.5% fall in the rupee, and that will hurt us badly in terms of our import bill. But of course, some exports will get benefit out of that. Real estate stocks hit very badly, minus 4%. Metal stocks, auto stocks, PSU banks, commodities, public sector enterprises, energy, everything collapsing between 3 and 4%. Bank Nifty overall was down 2.3%. Consumption stocks down 2%. I think mostly in tandem with the market, but consumption, FMCG, pharma, I think will do better in terms of relative outperformance from the rest of the market. So suddenly now the 18,000 odd levels are history. The trend line that we tried to cross 2 or 3 times for now is in the cold storage, and we now have to look at where the market will take support, where it may turn, and it may start a new leg up some point. And we are also coming into the result season, and if there are earnings downgrades coming our way, then I think it is going to be some longish winter from here on. Broader indices, small caps and mid caps taking a huge hit, almost down 4% at one point, but recovering somewhat, closing for 3.3 and minus 3% respectively. Nifty Next 50 also hit 2.7%. Nifty itself was down 1.8%, and CNX 200 and CNX 500 also down nearly 2%. Weekend investing strategies all hit between 3 and 4.5%, so no escaping the wrath of the markets today. And NG 50/50, which is Nifty and gold combination, dropping minus 1.1%. Heatmap for the day, there is no green virtually. In fact, there is no green. Some very light shades of green on the IT stocks, but Maruti down 5%, Tata Motors down 6%, Aisha Motors 4.5%. Huge hits in the auto space. JSW, Tata Steel, Hindalco down 4 to 6%. Huge hits here. NTPC, Adani Ports also down 3 and 5%. ITC down 4%. Huge hit here. ONGC, Coal India, Reliance, PPCL all down 2 to 4%. Asian Paints up. L&T flat. Nestle flat. Britannia flat. And some other stocks which managed to be near flat. Power Grid, which was down earlier in the day, there was a clarification that there is the rumor about it buying off REC is unsubstantiated and it recovered a bit. Top gainers in CNX 500 universe, still there were gainers today, that is surprising, but Imami up 5%, Rajesh Export up 4%, SKF India 3.5%, JB Chemicals 3.5%, Metropolis 3%. So these stocks one must try to, if you are a sort of a positional trader or you are watching individual stocks on a discretionary basis, you must see why these stocks went up in terms of their technical formation or so on and so forth, because this is out and out relative outperformance on a bad day. RBL Bank collapsed 8.5%, Thermax down 8%, Varroc Engineer minus 7.5%, Canfin Homes minus 7.5%, Vakarangi down 7.5%. So long list of losers, but some gainers as well. So we're talking about the UK 100 index. This is the top 100 market cap in the UK market. The index has not moved from 7,000 since the year 2000. So we've been at 2000, at 7,000 in the year 2000, then it dropped, excuse me, dropped to 3,500 by 2002, went back to near 7,000 and has been oscillating around. So this is what markets can do. I mean, Japan is one example, but there are other examples in Europe and in several other markets where the markets have not gone anywhere. So we need to be really thankful of having a growth market. We are in such a vibrant and growth environment, demographic dividend in our country. Just imagine if you were an investor in the UK and you were investing in UK stocks. Not everybody can invest in US stocks only. People invest in domestic stocks. So, you would have had no returns for the last 22 years. And it's not that UK doesn't have inflation. So you are losing money despite being invested in equities. So this, madness that some people have that we will keep 100% in equity because equity always goes up. Please take lessons from other places. Of course, we are not close to becoming a UK, but these are real life lessons. I mean, if we don't learn them, if we don't take others, experiences to, cover our allocations, asset allocation, then we are being really silly. So, clear example of equity is not going anywhere. And this was in UK, pound terms. If I see it in US dollar terms, then this market has not gone anywhere since 1997. 25 years no returns. In fact, from the top, it is down 50% in US dollar terms from 2008. Just imagine last 14 years and you are down 40-50% from the top in dollar terms. So crazy kind of investment returns. And just see what would have happened if you had an asset allocation to gold. So these are both charts in pound terms. The dark line is the UK equity returns, which is virtually flat. The orange line is gold in US dollars multiplied by US dollars GBP, and you can see that you had 868% rise in the gold price in local currency terms. So if you had even a 20% allocation or 30% allocation, you would have still made some returns out of this portfolio. So asset allocation continues in my mind to be the most important aspect of investing. Just because we've had some great decades does not mean that we can continue to bank on one-way growth in the equity. This chart is Nifty calculated in UK currency. So Nifty divided by GBP, and you can see that Nifty in pounds has also gained 1600% in last 20 years. So a UK investor, instead of investing in their local market, had they invested in Indian market, they would be sitting at 1559% return in their own currency. That is the power of investing in growth markets, where the currency flow is not really against you. This would not have been the case for US investors, because Indian rupee has depreciated a lot against US dollar, but against Great Britain pound we've done poorly, but not so badly from that perspective. So essentially the lesson here is there can be years, if not decades, of underperformance, poor performance, flat performance, down performance. Don't keep all your eggs in the equity basket. Please have asset allocation. Of course, your financial advisor can tell you how to do it and what all you should be buying. But I'm giving you an example of a non-Japan like situation where things have not moved for 2 decades, and that's where we have to learn from these examples. So this is all I have for today's daily bite. Thank you so much for watching, and don't worry too much about the market. Yes, we are in a sudden soup, but we've had this soup so many times, so don't worry about it. I think we are on a strong wicket in terms of consumption and growth in our domestic market, and as soon as some dust settles, I think we should be back on our track. So with that, thank you so much, and do share this with your friends and family. Thanks. Bye.